Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Hey everyone, this is Quincy Krosby. It is Monday morning. It is March 20th, and this is The Talking Point. And my goodness, what a morning this has been. Early in the morning, Europe, we were in the futures market in the U.S. Everything was in the red. Things are turning in Europe. Things are turning here in the U.S. That's obviously very good news. In addition to that, we're seeing the regionals up, the regional banks up. Granted, some of the banks that have been under pressure, they are still under pressure, but nonetheless, as I follow the news and all of this, what we're seeing is interest coming in from other banks looking to perhaps take over some of the ailing banks. This is all good news in the market. This is what you want. The issue in Europe was Credit Suisse had a bad headline. That's what I'm going to just say this, the headline. And the headline was, the Saudis are backing away. As it turns out, they are shareholders. They did not want to go above 10% in terms of ownership of Credit Suisse, and they claimed for regulatory reasons. But anyway, they said no. But it was clear Credit Suisse wanted more input, more money, more funding. Now, that said, a headline like that in an environment like last week, just grabs the market's attention. Credit Suisse has had headlines like that in the past. It's been, plagued by issues. But somehow they always seem to get off of the headlines. Somehow, they'll announce a reorganization, splitting up of parts of the bank, and also it always seems to have been followed by, we're going to go and buy up some of our outstanding bonds, and lending confidence to the market, and especially to depositors and folks who are in their wealth management unit who are managing their money from all over the world, just basically trying to stop and stem outflows. That's been the normal, how do I say this, series of events for Credit Suisse over the last at least 2 years. Now they come out with that headline, or a reporter got a hold of it, and in the backdrop, amid the backdrop of the sense that the banking system is cratering, even though it isn't, but that feeling, it just was red lights all over, and the government, the Swiss bank, central bank, went into action right away. Now, I do want to point out that UBS and Credit Suisse over the years has always been talk of, hey, would they ever marry? Would it ever be a merger? And then it would be off of the headlines and, just on and on. So this time around, yes, the issue for many is what happens to all the parts of Credit Suisse. Remember, they have a large presence here in the United States, as they do in London, as they do in other parts of the world. And, what is UBS going to keep? Credit Suisse had a plan that was unfolding, actually, where they were going to spin off their investment banking arm to someone who runs a boutique investment banking company, and they would resurrect the old First Boston name. Remember, when Credit Suisse came to the United States in the 90s, they bought First Boston. It was a revered company, and it was called Credit Suisse First Boston for a long time. Anyway, that's in flux as to what happens to the investment banking. For UBS, what is very attractive is the wealth management arm of Credit Suisse. That fits in perfectly well with UBS's wealth management arm. The issue that is a sticking point that has everyone worried right now is $17 billion worth of very high-risk bonds. I can't get into it on this call, but it is, they're difficult to evaluate, they're difficult to price, and also they're difficult to sell. They are risky, and it's $17 billion worth. The worry is that there will be zero, that ultimately it will be just deemed worthless. And that's a sticking point. But remember, it was the government that put this deal together. So it was the government that is basically if this it happens the way the market seems to think, has them just basically gone. And that was a sticking point this morning. There are other issues, but the fact of the matter is it looks like the deal is going to happen. It looks like it is being completely engineered by the regulators and the Swiss government. But I also want to point out that American officials were there, obviously, because they have a big presence, large presence in the U.S., UK, all over the world, all working on this to see if it can go smoothly. So right now, as I look, UBS shares are up. And in the U.S., we're in the green. To repeat, the regionals are up, and that's what we want. And we want more of the kind of action where not necessarily government brokered, as happened with First Republic. That was Janet Yellen putting together a consortium of banks to infuse $30 billion directly in as deposits into First Republic. But nonetheless, there are more and more headlines, if you look, that Bank A would like to buy one of the ailing banks. That would be good news. So in any event, let's get to the meat of this, and that is the Fed meeting. The reason is, just 2-3 weeks ago, the market was pricing in a 50 basis point rate hike. Then it obviously came down to 25 basis points, and now there are questions as to whether or not the Fed will actually go ahead with it. The market seems to think so. In fact, if you look at the futures market, it's still a 60% probability the Fed goes ahead with 25 basis points. Most likely, if things blow up again between now and Wednesday, which is the day that they have the announcement, maybe they don't have a rate hike. They want to, and remember, the Fed's mandate is bringing and restoring price stability, right, bringing inflation down, but they also have a major role in the global financial stability area. This is something that central banks work on. You'll probably see in the headlines right now that the Fed is engaged in dollar swaps all over the world to central banks. They do this periodically whenever there is a concern that there aren't enough dollars for the banks. So they're doing that now. That was like, how do I say that? Step one in trying to stabilize the global backdrop. But if things get worse and there's another blow up, maybe we will not have a rate hike. But right now, again, 60% probability. If all things are calm, we think that the Fed goes ahead with the 25 basis points. However, most likely, I would have to say my probability would be 90% to think that Chairman Powell is going to have to talk about this because he's going to be asked these questions at the press conference. Sir, why did you choose to raise rates given the backdrop? He will explain, and he may do what Christine Lagarde did, and she did an excellent job. They raised rates at the European Central Bank last week, 50 basis points, but she also made it very clear that the ECB stands ready to do whatever it takes, so to speak, to ensure global financial stability. And she was clear about it, and she talked about both of the roles that a major central bank has. So that's what we think the Fed will do, again, unless things go wild before that. In terms of economic data, and it's amazing that we're talking about this because everything has been colored by the banking situation. This week we will have new home sales and existing home sales, and we'll also have durable goods. Durable goods are important because deep in durable goods there's core durable goods. And what that is, it's a picture of what companies are buying. And companies, capital expenditures, that's what we call it, have actually been, for the most part, adding to their, capital structure, meaning the infrastructure, so to speak. And they're durable goods; they last a long time. They have been doing that. They've been allocating funds in their budget to do that. That's a very good sign. It is obviously a sign of optimism in terms of their own companies, their revenue growth, and in terms of the overall economy. That leads me to my last point here. And this is, you will hear it discussed if you're listening to the financial news. And this is, many analysts say the Fed does not have to raise rates because the transmission mechanism, just think about that, the transmission mechanism for the Fed's tightening campaign is actually happening now. Remember, that mechanism has to go right down deep into Main Street, at the very core of our economy. And why that people say that is that the financial conditions have tightened. And that means, and we could tell already, that banks are going to be extremely careful in terms of lending. They're going to be much more careful in who gets a loan, how much people could borrow. That slows down the economy. So in many ways, according to these analysts, the environment is doing the job for the Fed. And that transmission mechanism of the higher rates coupled with the tension in the banking sector actually should lead to the Fed saying, well, we don't really need to raise rates now because the market is doing it for us. Not so fast. The Fed still has to deal with inflation. And again, 25 basis points, it's not 75, it's not 50. It's still high. I mean, it's still a rate hike. But again, the economy is going to be doing it itself. And that is when financial conditions tighten, particularly when it has to do with the banks. So that would be a mechanism by which the economy slows down. So I hope you all got that. But if you turn on any of the news channels, business news channels or online, you will see a thread regarding that. And we haven't seen that, right, since the Fed has been raising rates. We've been talking about it. How come things don't slow down enough? Well, guess what? It's going to happen because this is what happened when banks come under pressure. They become extremely careful. So that's it. Also, other loans, auto loans, for example. Auto sales have been doing very well. But maybe now, because a lot of people do get credit, perhaps it slows things down. Exactly what the Fed wants. Now, mind you, they don't want things to crater. They don't want things to collapse, but they just want it to slow down. So it's going to be a very interesting Fed meeting. The press conference is going to be extremely important for the market to hear his views. Now, in terms of Chairman Powell, you've heard the fingers pointing at him. Elizabeth Warren, the senator from Massachusetts, just there was no ambiguity there. She blames him for this, for not doing his job. There's so much blame going around, but at the end of the day, as we always say, for our jobs in the markets, we trade and invest in the market we have, not the one we want. But it's still interesting to see how all of this is going to unfold. At the very least, we will probably have increased surveillance of the banks in terms of the supervision, at the very least, because one of the other Federal Reserve banks that is being criticized is the Federal Reserve Bank of San Francisco. Obviously, because two of the banks under pressure are from San Francisco. And, it was like, did anybody do any of this, any supervision on seeing as the Fed was raising rates? It would cause problems. So finger pointing, but we'll hear from Chairman Powell, and it's going to be extremely interesting. To repeat, right now, if there is no blow up between now and then, and if we could still remain in the green, so to speak, in the market, especially in the banks, 60% probability we get 25 basis points, but we get a very important, speech from Chairman Powell before the press conference, and we get that so-called dot plot, expectations for growth. Usually, when you have these kinds of pressures on banks and lending becomes more difficult, it does slow down the economy. So we're going to have to see where these dots show up and what the thread is and the thrust is coming from the Federal Reserve Board. So we'll be very busy this week. Please don't hesitate to call, and thank you very, very much indeed.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.